Hello and welcome everybody to the eToro Popular Investor Quarterly Forum. In today's forum, we've got a really great lineup of guests who are going to share their wisdom about everything that's going on in the markets, including a special guest that we have on today's panel. Before we get started as well, I just want to say that the information that is provided by the guests is not investment advice, and we are not employees directly of eToro. So I will get started to introduce the panel. Pietari, who's also known as Triangulacapital on eToro. So if you could introduce yourself, Pietari.
Sure. So I've been investing for about 20 years. The first thing I did was day trading, and that was a long time ago. And it worked well, but I had a full-time job back then, so it was taking too much of my time. So that's why I developed my second strategy. I invested in microcaps, which are very small companies from 2005 to 14. And again, that worked quite well. But in 2014, I noticed that it wasn't working as well as before. So I think that competition in the microcap space had increased. And that's why I developed my current strategy, which I run today. So now I invest in medium-sized and large companies, and that's what I've been doing on eToro as well for the last 3 years.
Excellent. Thank you very much for introducing yourself, Pietari. And over to you, 𝗧𝗃, if you could please introduce yourself.
Yeah, sure. I'm 𝗧𝗃. I've been on eToro for, I think, 7 years now. Having fun. Mission is always to try and democratize finance. I think that the world of finance is very difficult for the regular person. And eToro grants a way for everyone to join in and have your money managed in a very simple and easy way. And there's a lot of skin in the game, so I think the alignment of objectives is there. So I really like eToro for that reason and been on there for 7 years.
Okay, excellent. Thank you, 𝗧𝗃. And over to you, 𝗬𝗍, if you could please introduce yourself.
Hello, everybody. On eToro, I'm 𝗬𝗍𝗂𝗍 I've been on the platform since 2019. I've been investing since a little bit longer than that, 2016, 2017 or so. My portfolio is largely focused on tech and healthcare space, which are the two main areas of expertise for myself, because I come mostly from academic and research backgrounds, and I work in that space. So it was natural for me to create a similar portfolio and use my expertise to pick stocks that can outperform. Yes, thank you.
Thanks, 𝗬𝗍. And I'll just introduce myself as well. My name is Stephen and my eToro username is 𝗣𝗲𝗂𝗃. I've been on eToro since about 2017, but I've been investing probably for over 15 years now. And I invest in a variety of different stocks and different asset classes. And yeah, and I have been a popular investor since about 2020. And I also became a full-time investor in 2020 as well. Before that, I worked in a variety of management jobs all around the world in both the oil and gas sector and the healthcare sector. So I shall get started, and I think last quarter was a very interesting quarter, to say the least. I think it was a little bit tough over the last couple of months for most people and most people's portfolio. The last time that we had this forum, we were a little bit more joyful, and that is because there was a very good start to 2023, but there has been a pullback over the last couple of months. So I really wanted to dive into that with you all and discuss about like how things went in your portfolio in Q3 and some of the things that you think might have happened which affected the markets. So can I start with you, Zach, about how your portfolio went in Q3 and anything that you think might have affected the bad performance overall of the market?
I think my portfolio did okay. I don't know, man. Like we talk about this a lot. Like it's just spread widening for most of the S&P 500. So if we look at stocks, generally, nothing's changed in the economy. Interest rates are still up. The economy is doing a little bit better expected, but at the end of the day, it doesn't change anything fundamentally in terms of like stocks. Stocks, if we look at its discounting mechanism, nothing's changed. Only reason stocks went up is just because of compressions. People are willing to accept a lower level of return, especially for the Magnificent Seven. But other than that, no man, nothing's changed. Yeah, of course we have the war that's going on in Israel and Gaza, but has the markets been overly affected by it? Even if you look at oil, the war spread isn't exactly huge. It's come down since it popped till $90+ is now back. I think markets pricing in this is gonna not gonna affect all that much, but I think it might, especially if Iran gets involved. There are some risks there, but has the market fundamentally changed? I think it's been about the same.
Yeah, I agree. I think you're right there. I think the markets are pricing in that it's going to be contained, at least in that region. And I think we can see that from what's happened with the oil prices, a quick spike up, and now it's coming back to more normalized levels. Yeah. Okay. And Pietari, anything from your portfolio in Q3 2023, and anything that you think might have affected the markets last quarter?
So I think that the third quarter was quite good for my portfolio. It's more that in the last month, like stocks have fallen. So that wasn't yet seen in the third quarter. So I think if you now look at some of the latest problems, we've had interest rates increase. I believe we'll talk about that more later. That is kind of a change which has happened compared to before. If you think about 2 years before, interest rates were at close to zero, and now they're at 5%. So clearly, these higher interest rates, they can put some pressure on valuations. You discount all cash flows at a higher rate. And then, as Zach mentioned, the crisis in the Middle East. So that's obviously been putting pressure on the markets recently. But as he said, oil prices haven't actually increased that much. So I think it's a lot about time frames. If you look at the Palestine-Israel conflicts in the last 20 years, they haven't really been relevant for the market. So you had a couple of oil crises in the 1970s, the first oil crisis and second oil crisis. Those were very relevant for the market. But in more recent times, they haven't really been relevant for the market. So the most likely scenario is that this is kind of a temporary problem and we are going to get over it. Of course, there are worse scenarios if that conflict escalates. But in the base scenario, I think the markets become a little bit oversold right now. And I think that's why the most likely scenario is that there could be like a rally towards the year end. It's not guaranteed, but that's, I think, the most probable outcome.
Yeah, I think that might happen as well, especially when we consider the beginning of the year was such a fast start to the year, right? And so I think despite what's going on, everything with the economy and the geopolitical positions, it's quite normal for there to be a little bit of a pullback after such a fast start to the year. So Simone, anything from Q3 that you wanted to highlight? Anything that happened that may have affected the markets or your portfolio?
Yeah, so I want just to follow up a little bit on what Zach said about market didn't really change. I agree, like economy is pretty much the same it was 3 months ago, but one thing that I believe is changed is expectations. July, I think most of the not many people, but a significant amount of investors start to believe that they could see the lights at the end of the tunnel. And there was a lot of expectations that we could see continuously decreasing inflation and things were getting better and better. But even before the crisis in the Middle East with Israel and Palestine, we have seen confidence of investors changing. And indeed, from the peak in July, things start to drop quite significantly in terms of like NASDAQ and this kind of stocks, like growth stocks that perform very well. So yeah, basically now we know it's gonna take longer and longer, and we don't really know how longer. And these things, historically, didn't make any huge difference. This kind of wars between Hamas and Israel specifically, it still can delay the time we need for going back to normal. I think just that. I think basically what happened is just we need to wait longer. That's the only things that changed from 3 months ago, and investors adjusted to that. So they try to move a little bit defensively. But happy to hear your comments on this.
One thing that is making me a little bit uncomfortable, though, at the moment is that if you look at the reactions to the earnings reports of the Magnificent Seven, so you've had some like below expectations numbers, and you've had some above expectations numbers, kind of a mixture. But some of the market reactions to these earnings have been quite negative. So is the market now saying that the Magnificent Seven is too highly valued, or is it saying that maybe we are going to get a recession in the next 6 months, and that's why now investors are selling these stocks in anticipation of that? And then if the Magnificent Seven are not going to do well, then what implications does it have for the rest of the market? Because these stocks have been leading the market up this year. The rest of the market hasn't gone anywhere. Now, if these stocks go down, then do the rest of the market also go down, or can they decouple from the Magnificent Seven? So this would be a little bit my worry at the moment. So if we are going to get a recession in the first half of 24, which I believe is possible, at least a mild recession, then what's going to happen to the market over the next few months?
Yeah, that's a good point, Pietari. Obviously, when we look at the earnings of some of the large companies that have given their earnings, the majority of them beat their earnings. However, some of the forward-looking projections probably weren't as strong as people expected, because I think people are expecting that there could be at least a shallow recession in the next kind of couple of months. So I think it might have been the forward-looking estimates that are causing people to be a little bit nervous.
Personally, the things that makes me more nervous is that I do have some large cap stocks, but that one doesn't really worries me too much. I'm mostly worried about smaller cap stocks. So I actually would like to hear about this from Pietari. You mentioned you have been investing in micro cap stocks. So those stocks have very low liquidity at the moment. And if they have to wait longer before going back on tracks, they may just go and run out of business before inflation will go down. So that is, and then will cause a waterfall cascade that can propagate through even larger stocks.
So I think we have to make a distinction here between the small caps and the micro caps. So I think small caps, you have a bit of problem there. You look at the Russell 2000 index, and you can see that it's done terribly, and that's because of the higher interest rates. So a lot of these companies are not profitable, or they're cash flow negative, and then higher interest rates are obviously a problem for these type of companies. Now, if you look at the micro caps, then there's some more variability there. I don't invest in them today anymore, but when I did, then some of them are very leveraged, but some of them actually have no debt at all. So it really depends on the company, and they kind of tend to react to market news more slowly. than the larger companies. So you can sometimes get out of them in part because of the poor liquidity and the fact that people don't trade them so much like before, like other people sell them. So in a way, they can sometimes even be defensive in a market downturn.
And they tend to do better in risk-on environments, right? Rather than kind of risk-off environments like we're currently in. Yeah,
small caps definitely. That's like traditionally kind of play on the state of the economy, like more than like the large caps, which like let's say the Magnificent Seven kind of monopolies, they can do well even in recessions, right?
Okay, so do we think that we are close, at least close, or already there in terms of how high the Fed will put interest rates? What's your views, Pietari? Do you think that we're there? Do you think there might be one more small hike, or do you think that they're done?
2 years ago, nobody could have imagined or expected that interest rates today are at 5%, and at the same time, the market is still so high as it's today, and there's been no crash, no financial crisis, no nothing. But I do think that the Fed is more or less done now. I think if you look at the real interest rates, they've gone back to pre-financial crisis levels. So you have the US 10-year real interest rate, I think around 2.5% now. That's clearly in restrictive territory. They don't need to go any higher than that. And I think the economy has still been very resilient despite these higher interest rates. But I think in part it's due to the fact that the US economy, the structure of the debt is now such that there's going to be a longer lag between the increases in interest rates and when it actually affects the economy. Because if you look at the consumer sector, then you have 30-year mortgages. So the higher interest rates haven't really affected mortgage holders at all yet. If you look at the corporate sector, then again, the maturity of that debt has increased compared to 15 years ago before the financial crisis. So again, the corporations still, they can pay relatively low interest despite the higher interest rates today. But eventually, obviously, these higher interest rates are going to hit the various economic players. And I do think that next year we are going to see more impact on the economy compared to now. And I just don't see like why interest rates should have to go like much higher than this. Yes, there is a risk scenario that some of the economists that I read that they discuss, which is that, okay, we got a very strong third quarter GDP print. Maybe the economy will still stay strong going forward. Unemployment won't increase. Wages will continue to go up. And then in that kind of scenario, you could maybe see the 10-year US interest rate at, let's say, 5.5% instead of slightly less than 5% today. The Fed might have to increase rates more next year, as high as 6.5%. There is a risk scenario like that. And that would then eventually then crack the market and crack the economy. But we are much closer to the end in any case, like with these interest rates increases, than with the beginning. I just don't see like them going much higher from here.
The economy has been pretty resilient over the last kind of year or so. We have seen some resilience. We have started to see a little bit cracks come in now with the bond prices, the high bond yields, as well as some of the issues that we're having with the banks, which we're going to talk about a little bit later. We are starting to see some issues there creep in, but it has held up better than I think the rest of the panel had expected. Zach, do you think that rather than just if we will have another increase, do you think it's more important about how long they actually keep the interest rates up at a high level rather than if we just have a specific one more increase of a quarter basis points or whatever?
Yes,
what do you think?
You've gotten a little bit soft, like suddenly.
Sorry, my sound soft.
Yeah, it sounds like really. Yeah. I think you're a bit far from the mic. You're better now.
Okay, I'll repeat the question. I'll cut this out.
Yeah.
So I'll ask the question again. So Zach, do you think it's more important that how long they keep the interest rates at a high level, more than just if they increase by, you know, another 0.25% or 50 basis points, whatever that might end up being? Do you think it's more important that they hold it for longer?
Well, I mean, to me, I don't think it matters. Like, what's the difference between whether it's 5, 7, and how long they hold it for? It's just like whether you hold cash or you hold a stock. It's not making that much money. That's just how it is, right? Is it going to affect the economy much? Balance sheets look strong. Everything looks pretty good. I don't think so. Is there going to be like some kind of commodity super cycle? Too hard to tell. They may keep it higher for longer. They may not. I don't know. Too hard, man. Way too hard.
Yeah, it's a hard question. They've already kept it in place for quite a long time. And I think if they do start to eventually decrease the interest rates, I think it's going to be pretty slow. So it's going to remain, I think, elevated for a period of time before they're able to make significant cuts to the interest rates. And I think because of the lagging effect as well, they could end up keeping the interest rates at a high level for quite a long time. And as I said, things like shelter, that's a really lagging indicator, could actually overshoot it the other way and eventually bring down inflation to a really low level, because it's taken however many months for it to actually hit the economy. Yeah,
I have an interesting point on this. So Simone, Pietari, anybody, just feel free to respond. When in your respective countries or wherever, when's the last time you saw a housing downturn?
In Finland, there was a big housing downturn in around 1990.
1990.
There was a big bubble, and then house prices absolutely crashed.
How much did it drop by?
I think it was like probably, I would need to look it up, but it was like a big fall. Like lots of unemployment, interest rates were like super high. I think in real terms, it must have been like 30, 40, 50%.
Simone, Stephen, any?
Yeah, London's a pretty unique market, obviously where I'm originally from. Pretty unique market, and there's really not a lot of kind of land and existing houses to really go around for the population. And the prices tend to hold up pretty well in nice, decent areas. The more expensive areas actually tend to hold up better than some of the cheaper areas. But I think the last time there was a significant downturn was probably 2009, 2010. So it's been a long time, really. What I personally think is more likely to happen is I just think the housing market's going to end up being really dry for a while, because no one's really going to want to move now or in the short-term future while interest rates are really high, especially if you have to fix into a mortgage. And I just think the number of house sales will just reduce, and people will just delay when they move. So they'll just delay putting their current house on the market, and they'll delay buying a new house, unless something extremely bad happens with the economy. But I can't really see that happening.
Yeah, I'm cheating a little bit with this one. So I was doing a kind of scenario analysis, right? And this is because I bought a stock in Australia. So I was looking at the biggest fall in UK for property prices, right? And this was, you're right, it's in 2008. And it dropped by 18%.
Yeah.
18% is considered terrible for the housing market, yeah?
Yeah.
So if we think about the US market, like, how much do we expect it to fall by? If it falls by 30%, you're not just looking at like a tiny decrease, you're talking about catastrophe. You're talking about like people's savings, retirements. It's going to be a huge social economic issue. So you can't let it go to 30%. So what's a reasonable number that we can expect higher interest rates to affect these property markets? 10%? I don't know. It's a really difficult question. So I'm like, but how much downside can we expect? I don't know, man.
Yeah, I think in the US, it'll be different from state to state. I think like places like New York, you might sit with kind of limited land, you might see a different results compared to maybe somewhere like Texas or something like that. But yeah, I can't see there being a significant recession. I don't see us having a recession like 2008, 2009.
Exactly.
I think if we do have one, I think it's likely to be quite shallow.
I'm not an expert on this, but one little things about this topic. I think house owner have a much better diamond hands than stock owners. They rather keep it through the recessions rather than sell it for less. I know people are willing to wait even when they are renting out. If they cannot rent it at the place at the amount they want, they will just keep it empty. House owner usually don't negotiate, are not so willing to negotiate prices downside. So that makes a lot more difficult for house prices to go down. That's what I see in, at least in my region in Italy. Even here in Singapore, maybe it's actually better than me. Prices are not moving, they only go one direction.
I think we have to make a distinction, like with house prices, between the real prices, meaning inflation-adjusted prices, and the nominal prices. So now we've had high inflation, and I think that is actually taking care of some of the issue with high house prices. So if you look at the UK, where I live, then I think Lloyds Bank predicted that they released earnings this week, and they published some house price predictions, and they predict that the nominal house prices are going to fall about 10%. But at the same time, in the UK, there's a lot of inflation. So if you sum the nominal house price fall plus the inflation during a few years, then you are getting more like 20–30% inflation adjusted price falls. And that is the kind of price fall that I would expect, like even the much higher interest rates today. So that's good for players like banks, like a high inflation, because then the collateral that they have like stays relatively good because the nominal price fall is relatively limited. So in inflation adjusted terms, you do get like a massive price fall, like a big fall, but in nominal terms, it's not so big.
Yeah. Yeah, and I think the risk from the banks is a lot different to what it was in 2008, 2009. So they took part in a lot of kind of risk-taking behaviors in terms of real estate in 2008, 2009. And I think it's not quite at those levels that it was then in terms of the banks taking on huge amounts of risks and clients not having the money to pay their mortgages. Yeah. Zach?
Yeah.
You want to say something?
No, I just think it's interesting. What I'm trying to say in all this is, in a catastrophic event like 2008, like Steven mentioned, clearly the economy is not that bad. Clearly we don't have the same kind of credit structure and all that. 18% is absolutely catastrophic. If we think about like property now, shelter prices, if they come down like 8–9%, is it really such a bad thing? And if so, is it really going to affect the economy that much? I'm like, so I'm not sure, man. I think inflation is going to taper off. Maybe Pietari is right, you know, in terms of the real rates, like, is it going to be as well performing as others? Maybe. But yeah, I don't know. It's probably an interesting one. Shelter is an interesting one. So I think it's going to come down. I think it's going to be pretty level. I don't think it's going to drop. So inflation will probably just hang around.
Yeah. I think shelter's already started to come down over the last couple of months. It was obviously a lot later than the other factors like energy, etc., and coming down. I think obviously we just got the problem now that energy, although it's going down a little bit now, it's still up from those levels a few months ago. So I think that's caused the CPI spike over the last kind of couple of months. But I think shelter has been coming down gradually over the last kind of 4 or 5 months, I think. And I think it's we're likely to see more of that over the next kind of couple of months. Pietari, have you changed the way that you manage your portfolio in these higher interest rate environments? Have you changed your portfolio at all to navigate the markets, or have you kept consistent with your strategy?
So my thesis for some time has been that higher interest rates, they benefit value stocks in particular and financial sector. So that's why I keep most of my portfolio in the financial sector today, and that's been the case for the last few years, because I believe that this decade is going to be a decade of higher inflation and therefore higher interest rates. It's going to be a very different environment from the last decade. So if you think of what assets performed well in the 2010s, then obviously technology did fantastically well, cryptos, like any type of growth assets. And that was because interest rates were close to zero the whole time during that decade. Yeah. So low interest rates, they really benefit assets where the cash flows, the current cash flows are low, and most of the cash flows are a long time in the future. So this is typical of growth stocks, or technology stocks, or cryptos, which have no cash flows at all. But there's like multiple reasons why I think that interest rates and inflation are going to be higher this decade. So you have deglobalization, you have changing demographics, you have more activist government, like more fiscal policy, more deficits. Because of all of these factors, I believe that the portfolio for this decade, it needs to be very different from the portfolio of the last decade. So that's why I focus currently almost exclusively on the financial sector. It doesn't mean that I'm only like a bank investor or a financials investor. It's just, I think for the current environment, that's the approach that should hopefully work well.
Okay. And if we think that it's gonna be a totally different kind of decade to what we had from 2010 to 2021, 22, then so it's very unlikely that we're going to get back to zero interest rates. What do you think might be a more kind of average level for the next kind of decade or so? What do you think is going to be a level that we might find ourselves out at over the next kind of few years once they start reducing the interest rates? What do you think they might come down to?
Yeah, I think they will come down a little bit, but I think they're going to stay at like maybe 4% on average. So I think they're not going to go anywhere close to zero. But yes, in recession, it's going to be less than 4%. But like my view is that inflation might average around 3% during this decade. And I think interest rates are going to be higher than inflation by maybe 1%. At least, so then I get to that 4% estimate. So now we have like the US 10-year close to 5%. So I think maybe in a recession it might go down to 4%, but I think it's going to be in this kind of trading range, like 4%, sometimes 5%. But it's not going to go back to zero. That's my opinion.
Yeah, that will mean that inflation has been kind of persisting quite stubbornly. Sometimes inflation will go up and down, etc., and the Fed will react to the data that they have. Yeah, I was thinking around a 3% kind of long-term interest rate. I think that's probably what they'll move to. But they have this thing in their head, the Fed have this thing in their head about getting inflation to 2%. And they've had that in their head for a while. Even when we were lower than 2%, they wanted to move it to 2%. And then when it got much higher, Now their target is back to 2%.
They're saying that, and they will never admit that they're actually targeting something higher than 2%. Yeah. They can't say that. They will never say it. But I just personally think that in the back of their minds, they'll be happy with just a bit above 2%. They are not going to be like so strict about that, or they might come under political pressure. So a good example is next year we have the US presidential election, and at the same time now people think that maybe next year we are going to get into a recession. So is the Fed really going to put massive brakes on the economy just ahead of a big election? I doubt that. I think that the government is going to put a lot of pressure on the Fed to keep it just a little bit easy, so they can still maintain a certain plausible deniability. We are doing everything we can to get the inflation back down to 2%. But actually, they are not doing everything that they can. They are letting the inflation run a bit hot to keep unemployment low and keep the economy strong.
Yeah, and I don't think it's any surprise that they're going to be looking to reduce those interest rates towards when the US election is going to be, because voters usually respond pretty well to reducing of interest rates during this period. They may put them back up again, but yeah, I think it's probably a given that they're going to do that around the election time. 𝗬𝗵𝗍, do you have any views on like either what's happening with inflation or anything to do with interest rates? I also wanted to ask you, because you've got a different, I think you have a little bit of a different viewpoint to Pietari, and you're quite bullish on technology stocks over the next kind of couple of years. Do you want to give your kind of viewpoint on that, on why you're more bullish on tech stocks?
Okay, what we have seen and over the past year, but also over the past decade as well, what is the power of technology, how can benefit businesses in many different areas, from like reducing cost, boosting their performance, creating new products, everything. AI now is the most recent topics, but before that, cloud computing and so on. I think those forces are stronger than the negative force of inflation. They can defeat gravity. So if inflation is gravity that brings stocks prices down, AI and technology in general, it's like a rocket, and it literally can bring us to the moon.
I know what you mean though, 𝗬𝗍𝗍, because as well, I think technology is just by its very nature, it's actually deflationary.
Exactly.
Because the more technology you have in place, the less use you have for regular products and services, people, etc. And I think it's generally deflationary.
Yeah, I can see when I think about the most recent advances in AI, I just see huge amount of untapped potentials. A lot of people, I think, haven't realized it yet. So that will bring a lot of upside surprises in the future. So that's why I still remain bullish on that. But I also agree it will be too volatile a portfolio only on tech stocks at this stage. You will have huge swings, especially now that things are not settled yet. The economy is not on a stable point, it's not in an equilibrium. There will be a lot of adjustments in order to make sure that we bring inflation to the targets. Maybe we will overshoot, then we'll go down, and then inflation go up again. And I don't know, but it will take a little bit of time before things will go back to normal, and it's normal that it will oscillate in the future. But so just to reduce that volatility, I think it will be great to integrate tech stocks with some defensive stocks as well. which is why I'm very excited about having healthcare as well in my portfolio, because usually it's defensive, at least to reduce volatility. I think without that, my losses in 2022 would have been a lot larger. My gains in 2023 would have been larger as well, but you want to balance risk and rewards. Yeah.
I agree with you on that. Okay. And Zek, I wanted to move on now to a different subject and talk a little bit about some of the strains that the banks may be having at the moment with the high interest rates and some other factors. I know that during the kind of last bank crash, and we had Silicon Valley Bank, etc., we talked about this, and I think initially you did put some financial services stocks in your portfolio, etc. Do you have a different view now on current situations with the banks overall? And is it something that you're actively looking at or steering clear of?
No, I just like buying stuff that no one likes. So I think during the Silicon Valley, it was just obvious that everyone hated the sector. So it's pretty obvious.
Yeah.
Steven, you and I are crypto people, and 𝗬𝗵𝗲 as well. Like, it's hard for us to buy banks as crypto people.
Yeah, it can be very difficult. I mean, what the main thing about the banks is why I think that there is not more panic out there than there originally was, is because they basically, based on previous situations, they've almost guaranteed kind of bailouts of the big banks if there are troubles on people's deposits, etc. So I think that people are a lot less fearful of some type of kind of bank collapse than they would have been towards the start of the year, for example. But yeah, it is a tricky situation with the banks. I think they're definitely feeling the stress of these higher interest rate environments as well. What about you, Pietari? You are quite heavily invested in financial services stocks. Do you think that, how are the banks holding up?
So I think the answer to that question is that it depends. It depends a lot on the country that you're talking about. It depends a lot on the specific bank you're talking about. This year, there's been a massive divergence between the performance of US banks on the one hand and European banks on the other. The banking crisis, it broke out with Silicon Valley Bank in the US. And if you look at the bank performance in the US this year, it's been terrible. There's an ETF, KBE, which is the bank ETF, and that's down 20% this year. The regional bank ETF, KRE, that's down about 30% this year. So the US regional banks have done absolutely terribly. And that's fundamentally due to the change in deposit pricing, which was caused by the banking crisis, which broke out in March. But it's very interesting to see that at the same time, European banking index is actually up between 10 and 15% this year. You've been able to make money in European banks this year, and some good money. And one of the reasons why my portfolio has done okay this year, despite being heavily in banks, is because I focused more on European banks rather than US banks. In US, you've had a more competitive deposit market emerging. All the banks now have to pay more on their deposits, and that has compressed the profitability of all of the banks. Now in Europe, that has depended a little bit on the country. So if you look at the UK, then similar impacts as in the US. So you can see that with the latest third quarter earnings reports from banks like and NatWest, they reported earnings last week. Both were terrible, and the stocks fell 10%. And it's the same thing as in the US, which is happening in the UK now. So depositors have become a bit more savvy. They want more interest on their deposits, and that's why those banks are not doing so well. So those UK bank shares are also down this year. But then if you look at markets like Spain, or Italy, then in these markets, the banks are still able to get away with paying very little on their deposits. So the profitability of these banks has actually improved this year, and we don't see yet any kind of like trouble like in these banking markets. The Eurozone banks in general have done well. So those markets seem to be less competitive than the US market or the UK market. So now some people are speculating that maybe the same thing which happened in the US and UK will also spread to Eurozone next year, and these banks will start to suffer. I don't know, maybe that's possible. As a bank investor, you have to be very alert to this kind of thing and follow like the earnings releases and like all the data very closely. So far, we don't see evidence of that, but who knows? Maybe the same trend will spread. It is possible.
Is it because of the different speed of increasing interest rates? Obviously, in the US, they were a little bit earlier, and they're a little bit more aggressive in terms of increasing those interest rates. Could it simply be a lagging effect?
I think in part that is correct, yes. And in part, it's because the Eurozone interest rate is still lower a little bit than the US or the UK rate. So in the US and UK, interest rate at around 5%, and in the Eurozone at 4%. So there's just slightly less incentive for the depositors to start hunting around for better deals. And I also think that the markets in the Eurozone are a little bit more segmented. So if you're, let's say, a Spanish depositor, you're probably going to deposit your money in a Spanish bank, but it's not as likely that you would go to a French bank or like Italian bank or like a Finnish bank, in part because of language barriers, and in part because this is just how these markets have always worked. So there is no like single European banking market even today. So as a result, you are only looking at your own country's banks, and there's fewer of them compared to a bigger market like the US. So as a result, there's like less competition for deposits. So I think these kind of factors have played a role in that. So in general, are banks in trouble? As a depositor, if you're a depositor, banks are not in trouble because, as you said, those banks will be bailed out, right? We've seen it with Silicon Valley Bank, with Signature Bank, with all the other banks, Credit Suisse. Like no depositor has lost any money. If you're a bank investor, then I think there's a risk, especially with US banks, because they have a lot of losses on the balance sheets. The regulations were a bit weaker than in Europe. There's more deposit competition. So it's not like an easy investment. Like you look at the US regional banks, down 30%, but are they still cheap enough? I'm not sure. I still prefer like European banks to US banks today.
Yeah, that makes sense. That makes sense. There could be, I guess, there could be some good opportunities from these suppressed prices, but obviously the regional banks are probably a lot more suspect than some of the larger US banks, for example. So are you invested at all, Pietari, in bonds or anything like that within your portfolio?
So bonds, I think for a few years, if anybody asked me about bonds, I always told them that I'm not going to put a single penny of my money into bonds, because interest rates were at 0 or 1% or 2%. So the only guarantee that you had with bonds is that you were going to lose money after inflation. So now the situation has changed. So at 5%, bonds can already be like a reasonable investment. But I still think that you can make more money from some other investments. For example, you look at the banks and the PE ratios that the banks trade at, they are at like 5 times, 6 times, 7 times earnings. So the earnings yield you are getting is like 15% or even 20% in some cases. So if you want to diversify and you want some lower risk investments, then I think bonds are reasonable. But because personally, I'm happy to take like more risk in my portfolio. I just want like more high returns. So I don't invest anything in bonds. But for somebody who wants less risk, I think finally today bonds are okay, and especially the inflation-linked bonds. So I would prefer inflation-linked bonds to the nominal bonds, because I think inflation is going to be higher than what the break-even inflation rates embedded in those inflation-linked bonds are.
Pietari, I do have a question for you. For your banks that in your portfolio, are you wondering, are you looking at net interest margins potentially going up with interest rates, or do you think they hit the peak?
So I think we've hit the peak in many cases now, and actually the interest rates margins are going down already in many cases. So you look at the US banks, I think what they're saying is that interest rates margins will be going down, but they are hoping them to stabilize around the second quarter of next year. Then you look at the European banks, and it depends a little bit. In the UK, the interest rate margins are already coming down. Then in some other markets like Spain, they're still expanding. I have one South Korean bank, so that's a 𝗬𝗶 Financial.
Okay. Yeah.
Do you have that?
So
I don't have them, but I obviously know them. I'm based in Korea, so yeah.
Yeah.
So yeah, so they just released earnings, and they said that their interest rates margins are going to go down slowly over the next year. So in general, those interest rate margins, they are no longer like a tailwind for these banks. So that tailwind was there in the beginning when interest rates started to increase from zero. But now I would be actually happier if interest rates stabilized at current levels or even went down. That would benefit the banks more than interest rates going up even higher.
Got it. And new Basel rules, are you like concerned at all? Like for the new, or do you think European banks are sufficiently capitalized?
So I think we just got some earnings reports from the US banks where they discussed this, because there's a kind of the finalization of the Basel rules, which is going to be phased in the US from 25 to 28 over 3 years. I think the big banks basically said that their capital requirements might increase by 20%. And they are very much railing against that, because they think that they are already well capitalized, of course. Yeah. So they're not happy about that. But I think that if you look at the European banks, then generally those rules are now pretty much known. And you look at or you read the conference call transcripts of these banks, and you can always find that, okay, we think that our capital requirements are going to increase by 10% because of these new rules, or they're going to increase by 15% because of these rules. So we know the impact of those new rules now, and we can see the current capitalization of the bank. So we can kind of model like how much these new capital rules are going to hit the bank, whether they are going to need to retain like more capital, or whether they are already sufficiently capitalized. So I'm not so concerned about that, because what I'm concerned about always is the kind of things that you cannot model or that you don't know. But these Basel rules, by now, they're already known and they can be modeled. And so the analysts can like put them into their estimates. So as a result, I'm not really concerned about.
Okay, so that's a good segue for us to talk about Bitcoin and crypto as a whole. Bitcoin has had a little bit of a run since our last quarterly forum, and now Bitcoin is shot up to that kind of 34,000, 35,000 range. And I guess a lot of that is to do with the upcoming Bitcoin spot ETF, which is due for approval any day now, and always lots of fake rumors that it's already approved or it's going to be approved tomorrow. But I think with the deadlines in place, I think it's pretty likely to be approved at least before the next halving, probably quite likely in January, February, before January, February 2024. But it could come a lot earlier. And I think that this has caused a lot of anticipation in the market that there's going to be a lot of kind of buying volume moving into Bitcoin, into crypto. I think that was helped as well recently by Larry Fink of BlackRock, who called Bitcoin a kind of flight to quality because of some of the cracks that are coming in the economy, etc. So I think it's a pretty interesting time. And we also have the Bitcoin halving, which is due to happen, I think, in 2024, in which the mining rewards will be halved. So there will obviously be less selling pressure as well from miners. I think we could be coming up to a bullish period for Bitcoin and crypto, in my opinion, but very eager to get the panelists' viewpoints on Bitcoin and crypto, especially over the kind of the next couple of months, but we can move into some of what we think might happen in 2024, 2025 as well. 𝗧𝗃, do you have any views on the crypto markets and the way it's progressing? Do you see lots of bullish catalysts like I do?
I think the last time we did this conference call, we were just talking about GBTC and how we expected it to convert. So you and I were right on that.
Yeah.
But yeah, we still think it's going to convert. It's still a 10% discount on that. So if you want an additional 10% pickup, that's a decent way to express it. And it's the reason why I hold GBTC over BTC. But yeah, I just think that if the institutions come in, it's going to be interesting because they wouldn't go and create an ETF unless you have strong internal demand. It's not free to make these things, but it's not. They wouldn't do it willy-nilly either. So there's clearly some demand there. And so I think BTC is interesting. The rest of the crypto market, I don't know. It's especially Ethereum. I just haven't seen that many interesting projects come out recently. So that's why I don't have that much ETH. And same for the layer 2s, don't see that many interesting projects. But Bitcoin is the foundation, and I think it will have to fly before everything else. So happy to hold GBTC at the current value. In terms of halving, don't know. Yeah, but clearly the ETF is likely to be approved, and that's the first catalyst.
Yeah, I think so. I think there's quite likely to be quite a lot of volume coming into a Bitcoin, and it's spot as well. So it'll be, they will actually have to hold the physical Bitcoin, the custodians will. So I think you can see a lot of inflows being predicted. So I saw a report recently from 𝗤𝗟𝗏 Digital and 𝗤𝗟𝗏 Research, and they're estimating that just in year one, by the end of year one of the ETF going live, they're expecting inflows of about 14.4 billion coming into of new buying inflows coming into Bitcoin. So I think that's pretty significant in itself. And I think we're at pricing levels where, especially as we haven't seen a lot of Bitcoin move over the last year or so, Bitcoin's not moving between wallets, people aren't selling. I think everybody that had sold and had feared stuff in the bear market has sold already. So I think that there's not going to be a lot of supply on exchanges, etc. So if you have that kind of buying pressure coming into the market, I think it could have a pretty spectacular effect on the market. But I just warn everybody who's listening to this call that it's not going to be up only, and that it might take a while for those inflows to increase over time and for them to have a sustained kind of buying pressure on the market. But yeah, I mean, 𝗧𝗃, what do you think is a level which there's a lot of people saying that institutions could look to take 1% again of the total AUM for assets for clients, etc. Do you think that's feasible in the long term, or do you think it would be lower than that as a kind of institutions dipping their toe into the market?
Yeah, I think 1% it's asking a bit much of the market, especially look at traditional portfolios. How many of them have crypto?
I think in year one, I think you're right. I think it'd take a while to ramp up.
It'll take a very long time. So you're looking at maybe 0.01, I think, of like generally BlackRock's or whatever's AUM, so it's going to be small. And you got to remember they're splitting among many different ETFs, and Grayscale is still going to be there, and people would still prefer to hold their own Bitcoin. So there's a huge argument against like how much is going to come in. I don't know. I just know that we have to have some exposure to crypto. Doesn't matter who you are, you have to have some exposure. Because crypto is likely that crypto can halve, but it can also double. So your risk reward is instantly 2:1. Crypto has just very asymmetric returns, and you have to have it in your portfolio regardless. Yeah, I don't know. For me, once the GBTC closes the discount gap, I'll just split it among different cryptos. But for now, it's just GBTC. I don't see the catalyst for the rest right now.
Yeah, I'm expecting Bitcoin dominance to continue to increase. I think it's about 55% at the moment, Bitcoin dominance, or 54%.
It's like a 3 or 4 year high or something, right? Some crazy number.
But it's pretty high at the moment. I do expect that to increase, especially when the ETF is there. I wouldn't be surprised if it got itself to 6%. But then that's quite natural in these cycles, because people tend to consider Bitcoin as the kind of safest crypto asset. And then as kind of risk on behavior takes hold later on the markets, what is you then go further down the risk curve, you go to Ethereum, then you go to other kind of mid caps, smaller caps, micro caps. That's how you end up with these blow off tops at the end on altcoins, because people have gone so far down the risk curves that they're longing doggy coins.
One thing about Bitcoin, which is surprising, at least for myself, the effect of risk of Bitcoin depends by your portfolio. So if you have a lot of assets correlated to crypto, then adding Bitcoins will increase volatility of your portfolio. But in the context of my portfolio, I did some analysis, and the total volatility that comes out of Bitcoin is getting very low right now. Even when adjusted by allocations, like allocation size of my positions, my Bitcoin positions takes much smaller risk than what the Nasdaq is doing because of the lower volatility in the recent time. And that's very interesting. Then, still you have a lot of expectations. So if you have a low volatility and high expectation, that's a good indication that maybe a good investment. Obviously, will depends by what are the alternatives. Once the ETF will be available, you will have to sell some things if you don't have cash to buy Bitcoin, and you need to see if you're more bullish on Bitcoin at the time or not. Yeah. So it will depend by what is the condition of the other assets compared to Bitcoin. Right now, because everything is weak, Bitcoin may be very good alternatives. So if it comes sooner, this spot ETF, then a lot of people may just jump into that because they will expect better return from Bitcoin rather than many other assets. But if by that time economy will have changed, maybe somebody will try to buy some undervalued stocks rather than Bitcoin.
Yeah, I think that's a good point about having it in your portfolio. And I think this is what companies like BlackRock will think when they're recommending products to clients as well. By putting 1% of people's assets in Bitcoin, like a lot of people talk about the correlation between Bitcoin and the stock market, and say there's periods of time where Bitcoin kind of tracks what's happening in the stock market. But I'm not of that belief. I think there are certain times where there is some correlation with what's happening in the stock market, right, in specific periods of time. But I think if you look over the history of Bitcoin, I think it's not much more correlated than most other assets. Obviously, if there's like a liquidity crunch or whatever, like obviously what happened in COVID, when COVID first came out, everybody was selling all assets, right? So Bitcoin went down, gold went down, stocks went down, etc. And I don't see, apart from short periods of time in history, I don't see as much correlation as people seem to think in terms of Bitcoin compared with other asset prices. So yeah, it could be wise, whether it's Bitcoin or whether it's gold, to have some type of non-correlated asset in your portfolio. Pietari, I haven't asked you, I'm not actually even sure your views on crypto or Bitcoin. So we'll probably start off with that. What are your views on Bitcoin and crypto and the technology, blockchain technology in general? And then I'll probably ask you a little bit about how you see it currently in the current kind of economic climate that we're currently in.
So I'm like an old school value guy. So I like assets which pay dividends. Now, obviously, crypto doesn't pay dividends.
No.
So that's why, like, whenever anybody asks me about crypto, then I'll always tell them that I have never invested in crypto, and I'm never going to invest in crypto. It's just because I only invest in assets which pay dividends, like fundamentally. But I view like Bitcoin as a kind of digital gold. And so if you think of what drives the price of gold, then you have like a few macro variables which are important. So you have interest rates. So historically, gold prices have gone down if interest rates have gone up. Then you have the US dollar. Historically, if the US dollar is strong, then gold tends to be weaker. That's because like people who are not based in the US then have less purchasing power to buy gold. And one important thing for gold historically as well has been uncertainty. So gold has been like a hedge against geopolitical trouble. So whenever, let's say, trouble flares up in some part of the world, then people tend to buy gold as a hedge. Could we see Bitcoin as a kind of digital version of the same thing? So if so, then I would expect that its price would be affected by these same variables to some extent. Now, I know that, as you mentioned, Stephen, the price of Bitcoin has also been correlated to the NASDAQ, like quite closely, like much more than the price of gold. Like maybe because the same people who trade NASDAQ will also trade Bitcoin. So the same kind of like psychological influences will affect like both of these like assets. If people get more optimistic, then they will buy both of these assets. So if they get more pessimistic, they will sell both of them. But I found it very interesting that in the last 1 month or so, like the price of Bitcoin has increased so much. And this year in general, I think it's doubled. So interest rates have gone up. So we could have expected that because of that, maybe the price of Bitcoin should have gone down. But actually the opposite has happened. And now maybe in the last month, okay, you've got the conflict in the Middle East, so that's more uncertainty. Gold has gone up, so you could maybe think that, okay, Bitcoin should go up also. But I think it's gone up more than gold, even if you adjust for the like correlations. So probably the ETF like thing has also had an effect on that. I just give credit to anybody who saw that, like you have the Grayscale Bitcoin Trust trading at a massive discount, and then kind of forming a view that one day it would actually convert to an ETF and then the discount would close, because I mean, that's been a fantastic investment. I think you can definitely make money in Bitcoin, but it's just not my area of expertise. So I leave it to like other people completely who know more about that.
So yeah, I think we're actually gearing up for a very strong period actually in crypto. I think I'm a big believer in the kind of 4-year cycles. Yeah, definitely the selling pressure from miners does reduce as the Bitcoin mining rewards are halved. But I tend to believe that Bitcoin's much more kind of correlated with global liquidity. So
But,
as liquidity rises, that's when you start to see outperformance. And just the way that it happens, because of what happened in 2008, 2009, what tends to happen is you have these 4-year liquidity cycles, which is played out. So it plays out at a very similar time to the Bitcoin halving. And obviously the elections as well are in that same period as Bitcoin halving every 4 years. You also see those election periods. So you tend to see a lowering of interest rates and more liquidity.
question about this. Yeah. So you said that Bitcoin halving, miners will have to increase the price to maintain the profitability. If that's the case, is it, did I understand correctly? So is that the rationale that Bitcoin halving will push Bitcoin prices higher?
Yeah, it usually does, because what miners usually do is miners will obviously try to make as much profit as possible. And they also have to sell Bitcoin in order to have be able to pay for the mining equipment and the cost of electricity, etc. So as the Bitcoin halving happens and the halving rewards are halved, that means that there's less mining rewards and less sold on the open market. But what they tend to do just before, so you often see this kind of dip before the halving. And what usually happens is that they have to increase the hash rate. So they have to increase the amount of mining rigs in order to be able to get a more similar amount of Bitcoin rewards. So they increase their hash rate and they usually buy more machines. But usually
isn't it the same when energy prices goes up? Because if energy prices goes up, your rewards decreases, and then you will have the same argument.
No, so your rewards wouldn't decrease, but what would happen is your cost of mining increase, so your profitability would reduce. So the profitability does reduce, but generally what happens is the Bitcoin price tends to go up because miners aren't profitable at lower Bitcoin prices, and the market and then rigs will come offline and hash rate would reduce before the price would end up going up. So yeah, it's a mechanism of the 4-year cycle.
Yeah, from what you explained, for me the big winner are the businesses selling chips, because if you say that you will need a double, they are the one that double the revenue more than Bitcoin prices.
Actually, you're right. And like even during the bear market, the hash rate was going up. So the price of Bitcoin was going down. So the profitability of the miners was going down, but the hash rate has just continued to go up and up over the last few years, especially even during the bear market. Yeah. Okay. So I think what we'll do is for a matter of time, I think we'll move on to our last subject. And I asked the panel to prepare one of their best investment trading ideas in terms of an individual stock or asset class, which they're most bullish on in the future. So can I start with, actually, I'll start with you, Simone.
Okay. One investment idea, it's not completely new. I never mentioned this in this video course, but this is also why I want to talk about something new. It's weight loss pills. You probably heard about this. Market size, the expected market size for these drugs are probably, some people are expecting to be around $500 billion in the future over the next 5 to 10 years. That's huge. But so there are 2 key players right now, like Novo Nordisk and Eli Lilly, but they are already trading quite some high multiples. Instead, more bullish. Right now, it's still a bit on a transition phase, but Pfizer could be the next player coming to this field. So they have weight loss drugs in phase 2. Differently from Eli Lilly and Novo Nordisk, this is oral pill that you can just eat. Eli Lilly and Novo Nordisk, you need to inject it, which make it adoptions a lot more difficult. Eli Lilly and Novo already pressed in large profits from this, but Pfizer, people are still thinking, oh, COVID is gone. Why should I buy Pfizer? So they don't see beyond COVID. Most of the Pfizer investors don't see beyond COVID, which make it interesting stocks to look at. I already bought some of it.
Okay, and what is it going to be like for? Obviously, Pfizer has a lot of different drugs and lots of different revenue streams. Are we talking about a pretty large revenue stream for a company like Pfizer in these drugs?
If you look at the valuation of the market cap that Eli Lilly and Novo Nordisk now have reached, mostly only out of this, the expectation of this drug is just huge. That can also move Pfizer's price as well. But you're right, Pfizer is a big business. And indeed, there are a few other things that makes me bullish on Pfizer. One of which is the acquisition of Seattle Genetics. They paid quite a lot for that, but I think the drugs they are buying pretty good, and they allow Pfizer to expand in an areas they were not so good before, which is the oncology, mostly solid tumors market.
Yeah.
So there are multiple products that they may be able to get some good profits in the future. But remember, this is still in clinical trials, so nothing is guaranteed. But it's considering the fundamental of Pfizer, it's quite safe bets to do.
So, Manny, I got one last question on that, actually, and that is in terms of kind of patents, etc. I know they're obviously in clinical trials. How would that affect how? Thanks, Simone. Over to you, Pietari. Do you want to provide your one best investment trade or thesis?
Okay, so my idea, not surprisingly, is a bank.
Okay.
So it's Banco Santander. That's a Spanish bank.
Okay.
And reason number one is that it's very cheap. So if you look at the PE or price to earnings ratio of this bank, then it trades at around 5 times earnings for next year. And then what I like about this bank as well is that it's a global bank. So although it's a Spanish bank, they have operations not just in Spain, but they have operations in the UK, and there's massive operations in the Americas. So there's operations in the US, a huge unit in Brazil, in Chile, Mexico, the rest of Latin America. So it's really half a European bank and half an Americas bank. But it still trades like it's a European bank. So the valuation of 5 times earnings, that's consistent with kind of the lower valuations of the European banks. But it has a more diversified business profile. And I like that because there's some regulatory risks that European banks are exposed to right now. So for example, the European Central Bank, they have proposed a change or discussed a change to so-called minimum reserve requirements. And we don't know how much they are going to increase yet. So it's under discussion. And there's people have different opinions at the ECB. But if they increase it a lot, then that would be very negative for the banks. So the banks would make, like all European banks, would make less money. But because Santander is half American bank or America's bank, then it will be less affected by any change with the European regulations. So Banco Santander, they just reported earnings. Those numbers were fine, they were good. They are massively benefiting from the higher interest rates. In Spain, the market is still such that they don't have to pass on too much of the interest rate increases to depositors. And if you look at markets like Brazil, then actually interest rates are coming down there. So it's different dynamics compared to markets in the US or the UK or Europe. And interestingly enough, like these Brazilian banks, they position their balance sheets in such a way that they actually benefit now from lower interest rates. So there's like a tailwind for Santander from Brazil. So overall, if you look at the history of this bank, it has traded at 9 times earnings on average, and now it's at 5 times earnings. So if it went all the way from 5 times to 9 times, then we could see like up to 80% upside. Now, I don't think that there's quite so much upside, because maybe the future earnings are going to come down compared to what's estimated. Or maybe there's just like a lot of risks with this bank, so people are not going to pay the full 9 times. But still, if you look at the analyst estimates, what the analysts say that this bank is worth, then it's 40–50% more than today. And I personally agree with that. I think there is 40–50% upside, like in these shares, if they return to like a normal, reasonable valuation. And that's why I hold these shares.
Okay, thank you very much, Pietari. That's really interesting. Over to you, Zach. What's your 1/2 trading ideas?
Okay, so in the spirit of I like to buy shit that no one likes,
yeah,
I am going to pitch this one. It is Spirit Airlines. So it's ticker SAVE. It has been under acquisition from JetBlue since last year. So it was since, let's see, April 22. This was the offer. It is still not closed. And there's many reasons why it hasn't closed, but it's currently entering another antitrust, DOJ. And I think that it gets approved this time. I don't think the DOJ has any other reason to block this, so I think this goes through. The spread right now is 89%. So if it goes through, you make 89%. And if it fails, I think your downside is 50-ish%. So now you have a very asymmetric return because the market doesn't think it's going to happen. But at the same time, if it happens, your upside is huge. So I think this is an interesting trade. Having said that, the risks are very high. I would not, unlike most other merger arbitrages I like to do, this one I would not own if the merger failed. Like, saves balance sheet looks ridiculously bad. The other one I would like to pitch is iRobot. iRobot's supposed to be acquired by Amazon. And the reason why it didn't get through is there's some EU antitrust, and I don't think those antitrust rules really have much weight as well. So this one, the spread is smaller, but it's still massive, 43%. 43% upside, your downside is maybe 10–20%. So you're still looking at very good risk-reward return ratio. So these are the two that I really like. And the reason why I'm looking at merger arbitrage is I think that market is severely underpricing these opportunities. We saw it with Activision, and we saw it with Twitter. Market doesn't think it's going to happen. We realized significant upside. Steve and I were very lucky. I think we made quite a bit on Silicon Motion. That's another one that market didn't think would go through. We made, what was it, 80% in one day or something?
Yeah.
And Black Knight, yeah. So we did both of those. So we know that this area right now is significantly underpriced. Yeah. So I would like to continue in that vein and still look for these opportunities.
Yeah, there's a lot of those.
When is the acquisition gonna? When is the expected date for the acquisition for these two stocks?
No one knows, and this is the problem with mergers. Like, you never know.
No,
but looking at the court filings, yeah, you can read the analyst reports if you want. It's not very well covered, but the court filings are quite clear that
I think one of the risks, at least that I've seen for some, it was similar for Activision Blizzard. Definitely was the case for Illumina and Grail, is that regulators drag this beyond the due date, and then the acquiring company has to pay a fine, and then basic acquisition doesn't happen if you go past the deadline that they usually set.
Yeah, so the interesting one about the iRobot is Amazon renegotiated the deal, so they targeted lower. So they're still interested and they extended the date. Yeah, interest is still there.
Nice.
Yeah. Yeah, it can be difficult, can't it? Because I don't know, out of those two that you pitched, 𝗧𝗃, obviously I think Spirit's probably got the highest upside and probably the highest risk as well.
Okay, Stephen, you're up.
Interesting. Okay, I've done a lot of these. I'm going to choose a relatively newer stock that has entered my portfolio over the last couple of months, and it links in a little bit to what Simone in his first pitch. And the company that I want to talk about is 𝗬𝗏𝗏. So 𝗬𝗏𝗏 is a sleep apnea company and sleep focused company. They sell majority kind of CPAP machines for people with longer term sleep apnea. The price has gone down a lot over the last kind of 6 months or so. There was a lot more kind of competition that came into the markets with Philips and some other new sleep apnea machines, and it also, they had to do a lot of kind of marketing, etc., which kind of eroded some of the margins, etc. But now I think that the margins are starting to improve, but the valuation is a lot better than it was. I also think that there's a few demographic things that are going to be very good for the stock long term. One is obviously an aging population. The older people become, the more likely they are to use sleep apnea machines later in their life. And also there's obviously a rising increase in obesity and type 2 diabetes, etc. And obviously we know that weight does play a factor in higher uses of AED machines. I think one of the other reasons why the stock has actually been down recently is to do with those weight loss drugs that are in trials at the moment. Simone mentioned, obviously, if it could be rolled out more globally and more widespread, then it would reduce the occurrences of sleep apnea. But as Simone said, I think we're in the very early stages of that, and I don't think the doctors are going to be likely to want to prescribe weight loss pills to the majority of people. So yeah, I just see it as a potentially a growing business over time. And I think the valuations have come down a lot, and I just think that there's some really good upside to it over the next kind of 18 months to 2 years. And so yeah, that's my thesis.
Just to add on what you just said, the implication of this weight loss drugs, yeah, it's really affected stocks that you wouldn't imagine when you invest in healthcare. McDonald's stocks was affected by this because obviously, so this effect is it's a weight loss pill. It's not that it's burning your fat. It's basically moderate your hunger signals from the brain.
Yeah.
Let's say. So it will make you less hungry. And so you don't go to McDonald's. And so that's the connection investor did. And then stock prices dropped a little bit. Probably recover.
Overhyped, but at the end of the day, I don't think doctors are going to be prescribing them to every.
Yeah, probably not. Also because the one that are currently in the market, you need injections, so it's not something that you want to do every day. So it's not so easy to.
No, yeah, I agree with you on that. All right, so that's the end of the pitches. I think we will end today's forum there. I really want to thank all the panelists for joining today. I had a really interesting discussion. So thank you all for joining, and I'm sure that the audience will get out a lot from today's session. from listening to this audio. So thanks everybody, and goodbye.
Yeah, thank you.
Thank you.